Hey guys, today is February 20th, 2021. Thought I'd put together another video because I have the house to myself and it is completely quiet. That's a rare occurrence around here. So when I have that opportunity, I have to put together one of these videos. All right, so we've been working on a Vega neutral portfolio strategy for a couple of months now, and it's been very profitable. It's been very easy to manage. Not a terrible lot of management, but you do have to check in every day. And The main thing is that it's doable. It's definitely something that is worthwhile, and it's worth the time to get to know how to do this thing. So let's summarize where we are. So far this month, we started this position at the beginning of the month, February 1st. We're about 15, 20 days in with all these different positions. There are four main option strategies going on. One in IWM, one in the Dow, one in the SPY, one in the Triple Q. And as you know, all of these underlyings are tightly correlated in price, like lockstep most 90% of the time. So we're not, one point I want to make here is that we're not diversifying our risk by doing these, different things. We, because price and all of these underlyings pretty much move lockstep. So if one goes up $2, all these other ones are going to go up $2. If one goes down $2, the other ones will go down $2. Um, and so we're not diversifying in that sense. What we're diversifying is in our option strategy. So an example here is, let's look at IWM. And IWM, the delta is negative 14, gamma is negative 3, the theta is positive, and the Vega is very positive at 103. So this is telling us that this is a positive Vega, positive Theta trade that's slightly delta negative, meaning if the price goes down $1, we make $14 here. If volatility goes up a point, we make 103. And if time continues to move forward, which we expect it will, every day that goes by, we're going to make $36 in this position. Now, this is a certainty. Theta is our certainty. We like theta. We want theta to come in every day. We want theta to be positive. Um, Vega, think of it as a risk factor. Price is a risk factor. Gamma is a risk factor. And what we're doing is using multiple different strategies to diminish our Vega risk and our delta risk and gamma as much as possible. And therefore, when we do this right, our theta is the dominant, should be the dominant Greek in our portfolio. Theta is the dominant Greek. So after summing all these different these different strategies, what do we have? We have a delta neutral, theta positive. I mean, the theta to delta ratio is almost 100 to 1 here. The Vega to theta ratio is 5 to 1, which is good. I mean, these numbers do change. So once you adjust these positions, they will continue to fluctuate, and that means you reassess the position and do another adjustment. But overall, as of Friday, we're up 600. The last video, I think we were up like 200 into the position. We're up 600 so far in the open position, and our theta decay is really starting to pick up. We're at the mid cycle of the option cycle. So this is where theta really starts ramping up exponentially day to day. So we've been in and out of IWM a few times. Let me just show you the account statement. So here's IWM. This is the calendar spread. Right now it's $40 up, but you can see, we've made 500 on this spread by taking off profits and readjusting. Let's look at that one position. I want to focus on this one because you can see that it's, here's the center of the graph where you're really getting the meat of the theta decay. And the prices push this thing really almost close to where our break even is. So we're currently at 225. Another dollar up, and we're starting to lose right in here. Okay, after you hit that break even, we're starting to lose. So even if we go to Monday and we get a little more theta, we're still just a few dollars away from this upper break even, 227, and that's where we would start to lose. Okay, so how can we prevent that from going forward? So Monday, this is the adjustment I'm thinking about doing on this one. So going into Monday or Tuesday, if the market continues to ramp up, which it is doing, okay, one of the adjustments is you can just take off the whole thing and reposition. A second opportunity, a second type of adjustment is where you would add another calendar spread. Okay, currently we have 10 contracts here, and we're selling 10 contracts, buying 10 contracts in April, and our total risk is 3,000. Okay, if the market gets to 227, and we can model that right here, we can just say, hey, it's the 21st. No, we got to go to 22 because that's Monday. Let's say we go to 22 and the market comes up to 228. Right, so we can put the price right here, 228. And at 228 Monday, the 22nd, we would be at a $23 profit and just really close to this upper break even where we start losing. 228.57 and 228.51 is where we start losing. Okay, so at that point, I'll have an alarm. See, I'll put an alarm at these break evens where if the price hits 228, it'll buzz my cell phone. If it comes up here to this break even at 215, there's another alarm. Okay, and I know that if it's hitting that level, I got to do something. So what I would do in this case is I go to the option chain, and pretty much we're around a 40 delta on the put side. We're set right. See, our position is right here at the 40 delta. All right. So in order to get delta neutral, I have to come over here to the call side and sell an equivalent amount of positions at the positive 40 delta. Same expiration. Sell the March 19 by the April 21. See, our long positions here, our short positions here. So let's see what that would look like. So market is up here. We're saying it's Monday 22nd. Market comes up to 228, close to this break even, and I have the calendar already set up here. We're going to sell the 230 call calendar and buy the one in the back month in April 21. And when we do that, this is what our graph This is what our graph will look like. Okay, it expands the break even. See, now our break even pushed out a little more. It expands the entire 10, and it gets us uh, slightly better position, but slightly still delta negative. All right, let's see if we can play with the price a little bit too. We can go up to 221. See, that spreads it out a little bit. Now it's even wider. We can see what it would look like at 230, 231, and then look at the deltas, negative 11 here, and then 232. So that brings our deltas to almost totally delta neutral. And our theta here is 68.22. So it's a really high theta to a really high theta to delta ratio. We have to watch our Vega. Our Vega doubled. See, we went from 110 to 220. All right, so Vega doubled, and our risk as well doubled. So we went from risking $3,000 to now you're risking $6,000 to get back to a delta neutral position. So that's something. Those are the risk factors you have to weigh out. You know, is it worth it to add to the position? And a lot of times, you know, you're looking at how much time is left. We're looking at how much time is left in the expiration cycle. So it's still a good amount of time left. So to adjust now in this way makes sense if you have the capital. You know, and then what we would want to see is some stability in this range between 232. See, now our upper break even is here, 232 to 223. We would want to see some stability in this range. And we would wait for time just to kick in and wait for the theta decay to kick in. Now, when do you get out? See, now you're risking more. Okay, you're risking 6,000. So your profit target is like at least 10%. All right, at least 10%. You want to get at least 8 to 10%. And that would be, you know, doable because, you know, you're really bringing in more theta by making this adjustment. And that would bring our deltas back to neutral. But there's also, you know, it's like you have to really think about, yeah, it brings your deltas back to neutral, but what is the cost? It brings your deltas back to neutral, but how much time do I have left in the expiration cycle? So there's always a cost to everything. And then you have to look at the entire portfolio as well. So right now, the IWM Vega is 100. And if we double the size of this position, it's going to go to 200. And that's going to mean that now we have 100 extra. We're going to be long 100 Vega. Okay, do we want to be long 120 something Vega? Our theta is 94. So that's just another consideration you have to take in. How does it impact the entire portfolio? All of this is working well right now. But when we make these adjustments, you might have to make 2 other adjustments just to get the entire portfolio relationships right. So it's an interesting game, and I hope this gives you some insight into risk, the risk part of trading, you know, and we'll keep talking about this. But it's been great, and it's been a good learning experience for me to do things like this, and we'll keep talking. Okay, have a good weekend.